over Zoom. We're gonna find a couple of things today for the Zoom stock. It's around 400 bucks. We're gonna find number one, the fair value according to Warren Buffett, as mentioned in the book The Intelligent Investor, written by Benjamin Graham, his mentor. We're gonna find if Warren Buffett will be a buyer according to all the financial statements of Zoom. I'm gonna go over the financial statement for beginner so you guys can understand how to read financials for Zoom and for any other stock for that matter. And the third thing that we're gonna find is if Zoom will be a buyer for Warren Buffett, which he would like to get 33% discount on the fair value. We're gonna find an exact number, we're gonna find the discount number that Warren Buffett will buy, and we're gonna find out if Warren Buffett will actually be a buyer according to the financials. Let's get started right now. I'm in the Excel how to value a stock like Warren Buffett, which you have two options. You can either read the book The Intelligent Investor by Benjamin Graham, 600 pages, and make the formula yourself, or check the description below. My Patreon costs 10 bucks a month and I posted the link to this formula. You put a few numbers and you get the fair value of any stock that you are looking for, as long as the earnings per share are positive and the growth number is positive. Now let's start with Zoom, and we need to find two things. First of all, we're going to find EPS, earning per share, from Yahoo Finance, and we're going to find the growth. Again, Yahoo Finance, so let's go. So guys, I'm in Yahoo Finance and I'm looking for Zoom, currently at 410. It went from around, I don't know, 550 like a month or two ago, now down 30% to 410. They posted some earnings and went down from 480 to 400, and now they're sitting at around 410. Is it undervalued or overvalued? We shall see. Market cap is 116 billion already. Something else that I want you to guys see, this one, PE ratio, trailing 12 months, 284. Pretty high, pretty high. Now for you guys that don't know what PE ratio, let me make it very simple. PE ratio, you just take this number and according to the earnings of the company, this is how many years, not days, not months, how many years will take you to recoup your initial investment if you buy Zoom today at 410 bucks. Just shows you how this market is extremely overvalued. It's gonna take you almost 285 years to recoup your initial investment if and only if Zoom earnings stay constant, not going up and not going down. Stays the same, you're gonna need to have about 285 years to get whatever that you invested. Just telling you how it is, guys. Keep this with a grain of salt. If you ever think about investing in a stock, the first checkup is to see the PE ratio. Doesn't mean that it's not gonna go up. We're gonna find the fair value, but 285 years. Tesla is like 1100 years, which is insane. But anywhere over 10, 15, 20, 30 is good, but not 285. Just throwing it out there. We need two numbers, guys. We need EPS, earning per share, 1.44. That's number one. So we're gonna put earning per share 144, and then we're going here to the analysis tab, and we're gonna scroll all the way down. Okay, and here we find this. That's pretty crazy. Next 5-year growth 130%. So I assume that's why the price is going up and up. They think that the share will grow up at 130% rate per year for the next 5 years. It's completely crazy if it does. The analysts think so. Doesn't mean it's true. Could have. Here 730%. Next quarter 280%. Current quarter 430%. Just insane numbers. If it's true, that means that we are all quarantined or everyone are working for home for the next 5 years. I don't own Zoom, not a financial advice, but I think this number is extremely positive and optimistic. But either way, I'm gonna put 130.8 and we're gonna see what we see in the Excel. In the Excel, the EPS is 1.44 and growth is 130.8. That's it for now. 130%. I assume the price of Zoom, because it's 130%, that's why it goes up and up and up. That's a super ideal optimistic option. Doesn't make it. We'll see. I don't know. Let's go over before we find the last item in this Excel, which is AAA bond yield for Zoom. Let's go over the Zoom financials and see if they make money, if they do a buybacks, if they give any dividends, or are they just burning cash? We'll see. Let's see what Warren Buffett wants to see. Yeah. Back in Yahoo Finance, I'm going here. Financial tab. Okay. Financial tab. And I'm looking for a couple of ratios. I'm looking for, first of all, I want to see that they're making money and growing. And then I'm looking at some ratios. So first thing, according to Warren Buffett, just look like roughly what's going on. So you see in 2018, they made about 150 million. 2019, they made double, 330 million. And 2020, even double that. It's just 620 million. And the last 12 months, the same thing, 620. That's pretty good. They jumped from 150 million to 600 million. That's 400% jump. Very impressive. Very impressive. How much did they make gross and then net? I would like to see according to Warren Buffett. So I'm looking at this number. Gross profit, 500 million. 507 million. I'm gonna divide it by 622, and Warren Buffett would like to see about 40% and up. Apple is 38%, for example. Tech and software companies are around 75-80%. Seems like around 80%. I'm gonna get the calculator, and yeah, let's see what we see. First, my calculator. I'm taking 507.262. That's all you need to do. Divide by 622.658. 40% for regular company and around 80% for a software company. That's what ideally I'd like to see, and not just me, Warren Buffett. And we got ourselves 81% gross profit. Pretty good. So far, they checked the first box in Warren Buffett for the check mark, as they say. Now I'm going all the way here to the net item on our list is this one. Diluted NI available common stockholder, meaning how much net, diluted net income, how much net is left with Zoom after all the expenses. So we got about 81% gross profit. What's the net profit? Warren Buffett would like to see 20% and up. And let's see. So we're taking this number, 21 million, 0.750, and we're dividing it by the total revenue, which is 622.658, and ideally it's 20% and up net. And we got ourselves a very, very bad number of 3.5% net income. Meaning they're not making as much as Warren Buffett would like them to make. They're making 3.5% net. So that's all. That's all. It's a nice growth, all the gross and total revenue, but net, what left in their pocket is 3.5% net. And at this point, I mean, it's not looking good. Let's move on to the next item on our balance sheet or the financial. Let's see. The item on our list is the balance sheet. We want to see a couple of things. First, we want to see that the total assets are growing, and they are. If you look here, 2018, 250 million. The year after that, 354 million. And this year, just explosive growth, 1.3 billion. They almost 4 times their assets. And the gross revenue, the net is super weak, 3.5%. That's not good. But I am looking here for this total liabilities, and specifically the second column, total long-term debt. That's what I'm looking for. Total non-current liabilities, and inside that I'm looking for the long-term debt. Okay, and I'm gonna look for this number, 64 million. I would like to see they can pay their long-term debt. That's not a lot, 64 million. It's pretty nothing. I would like to see that they can pay, not me, Warren Buffett would like to see they can pay their long-term debt in 4 years or less. So we're taking this number, 64.2 0.792, and we're dividing that by the net income. That's all. You go back to the income statement, you go to the diluted net income, you divide that number by 21,750,000, and we would like to see a number below 4, meaning less than 4 years. 3 years. It's gonna take them 3 years, give or take, to pay off all their long-term debt. That's absolutely nothing. That's spectacular in Warren Buffett book. The only downside is the net income, which is 3.5% net. But they can pay off their long-term debt for a software company that is profitable. That's a pretty good sign. That's a pretty good sign. It's a growing company, you know. They're not perfect. They're not been in the market for the last 20, 30, 40, 100 years. I don't know how long they've been, probably a couple of years, but everyone are using them. They can pay off their long-term debt in less than 4 years, in less than 3 years. That's a good check mark in Warren Buffett book. Let's go check cash. I'm now in the cash flow statement, and I would like to see a couple of things. Number one, I'd like to see operation cash flow positive, investing cash flow negative. So we got check mark yes, and finance cash flow negative, and we got a positive. So that's not a check mark, and that's a problem. But let's go over things. Operating cash flow 151 million. That means the money from Zoom, people using, businesses, enterprises, the money from the actual product, 150 million. That's good. What are they doing? They are investing 500 million back into Zoom. That's a good thing. I want to see the money goes back into the company, so the company can grow, expand, and so on and so on. But this I don't like to see. 650 million finance cash flow. What does that mean? Let's go deep and see exactly where did that money came from. We got ourselves net common stock issue. What did they do? They issue more stock. They issue 542 million more stock. Instead of buying back the stock, we will see if they did a buyback in a minute, but they issue more stock, meaning they have diluted their shareholders of Zoom. They produced more stocks instead of doing a buyback and buy back the stock and remove it from circulation. They actually put more stocks in the circulation. That's not good. I assume they did it for, I don't know, maybe get some more money, just expand. Whatever the case, this is not good for the shareholder itself. But let's see exactly what they have done. And here's the total outcome. Here's what they did. Issue of capital stock. They issue stock, as I said, 542 million. It's not good. That's diluting the shareholder. Issue of debt. There's no debt. That's good. Debt payment. They didn't pay any debt, so that's they don't have too much debt. That's fine. Did they do a buyback, repurchase of capital stock? No, zero again. So all they did was issue more and more stock and dilute their shareholders in the last 12 months. It's not a good sign. Free cash flow 113 million compared to 20 million about a year ago, which is almost 6 times more. That's crazy growth. Looking for another ratio in here. We got this number, capital expenditure 38 million. The goal we would like to see with this ratio, how the management of Zoom spend their money that they make, spend their cash flow wisely and efficiently. As long as that number is below 25%, they are spending and expending they're spending the cash flow super efficient. If it's 25 to 50%, they spend it average like any other company, and if it's over 50%, they just spend it not that good at the end of the day. So we're taking that number 38.225 and we're dividing that yet again. We're going back to the income statement, going all the way again to the diluted, divided by 21.750. I'd like to see a number below 25%. Let's see. And we got 175%. Not good at all. That's bad. That's horrible. That means that the management of Zoom, not a financial advice, just from what I see as ratios, spending their free cash flow not wisely. Warren Buffett would like to see 25% or less. This is 175%. There's no excuse. I'm not buying Zoom. That's Warren Buffett will not buy Zoom. He might buy Zoom, but according to all the ratios that he follows, he will not buy Zoom stock, especially with the PE ratio. That's a different story. But we need to find the fair value of the stock after doing all these calculations. So let's go back to our Excel. So I googled Zoom corporate bond rate. I guess I'm not the only one who is afraid with all those high numbers. And their bond maturity rate is like super high, the highest that I've ever seen so far since I started this channel. 8.52. That's extremely high. Back in the Excel, I'm gonna put the extreme high number that I found for Zoom corporate bond, 8.525. Extremely high. And once I click enter, we're gonna find Zoom fair value. I don't know, I think it's lower than 400. And the price that Warren Buffett will be a buyer, even though with all his check mark, he will not be a Zoom buyer. About 150 Patreon members as well, link in the description below. Hey, with that being said, guys, let's find out Zoom fair value. Dum da da dum da 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 dum. $200. $200, half from 400 that we are today. Even though Katie Wood, ARK Invest, is buying and buying, she bought since 500 like a month ago. It's 400 now. Fair value is 200, and the price that Warren Buffett will actually be a buyer of Zoom is like 135. So 400. As I said, I'm not buying Zoom. If you bought Zoom, that's you know, look at all this stuff. Don't just buy the hype. Look at the financials. Look at they diluted the shareholder. It's gonna take, I don't know what I said, like 500 years or something to recoup your initial investment. You know, it's if they go down to 200, it's still not enough because Warren Buffett would like another buyer. It is what it is. It is what it is. I love Zoom. I use Zoom, but I'm not paying. And if I bring you guys any value, don't forget to subscribe to my channel. Hit the bell notification so you won't miss any videos. And leave a comment below which stock would you like me to analyze next. I hope I brought you value, and I will see you guys in the next video. Thank you very much. Yeah.